So, hello everyone. I hope you all are doing well. In this lecture, we will discuss some of the important strategies while you are buying and while you are trading. So, for example, the most important strategy which I've came to know after many failures is that you should always buy in parts and you should always sell in parts. Now, why is that so? Let me explain. So, for example, if you take this line and if we want to draw the support line, so what this could be one of the support region, this could be one of the support region, and this as well could be the support region. So now, as you see, so for example, if we analyze according to the other indicators, the MACD has having a crossover, but it is a bearish crossover. So it is not supporting this trade, and the RSI is also 51. So it is also not supporting the trade because around whenever the RSI is not between 20 and 30, it means that it is sideways and not obviously in 70 and 80. It means that it is sideways and the market could usually go down from here as well and go up from here as well. So if we could have the MACD or an other type of indicator, we would take the trade then. So let's suppose that the RSI and MACD is supporting that we should is indicating that we should take the trade. Now, what should be the price at which we should place our order? So if you could look here carefully, that here 30, at 33,669 here there is a support here. So we could place this order here. So for example, let's imagine that you have $200. Would you place a $200 here? And the answer would be no. You would not place your whole $200 at this price because we could see that this BTC would go down from there as well. And the and usually, for example, this could happen because of any news. For example, in recent times, we have seen China doing that they spread there's some sort of negative news and the Bitcoin price goes down. So what if the Bitcoin falls from here? So we need to imagine and we need to consider all types of possibilities. So whenever you are buying any coin, any currency, you have to you have to buy in parts. And what we mean when we say buy in parts is that you should buy, for example, if you have $200, you should buy some here, and you should buy, for example, you should buy $70 here, $70 here, and $60 here. So basically, what it would do is it would average your cost, meaning that it would make, for example, if you buy with $200 here, it would mean that your cost would be 33,669, and you could only be in profit when it is above that price. However, when you buy in parts, it would generally be average to around 31 or 32, means that your total cost for buying BTC would be much lower. So this is one of the important tips which I've came across after years of trading. And other important Similarly, another important strategy is that, for example, if we measure the resistance, now this could be the resistance, and this could be the resistance, and this could be the resistance as well. So if you are for like if you are planning to take out profit in a week or in a 2 week, so you don't need to sell all of your, for example, if you buy from this point and the Bitcoin goes up, so you don't need to sell all from here. You should sell some of your amount around 30% and book that profit, but you should also keep for the higher price range, for example for here and for example for here. And what would this mean is that it would make your profit much more higher as you are selling in parts and you will sell at the highest price as well. And what would happen if if the price never reached here and it just hit this two if it just hit these two price and it never hit this, what, 41,135 price, is what would happen is that you will be stuck in this trade for a much longer period. However, if you would have set these two prices, you could have again taken the trade and you could have again booked the profit. So basically, the o- opportunity cost of not using your funds is can be anything. So you must use your funds wisely, and so that you should buy and sell in parts. This is one of the important strategies that you must keep in mind. So another important and other very important term is to define yourself at what you are doing right now. Like what is the type of trade you are taking, and for that you would need to know the different types of trade. So basically, there are two types of trade, which one of them is swing trade, while the other one is intraday, or you can also call that scalping. So these are the two types of trades which you could take during that period, during your trading period. So what are the these two types of trades, and what is the difference between them? We'll first start from the swing trade. So what the swing trade is basically, as I've discussed in the RSI and MACD, that the market always repeats its cycle. So what the swing trade is that you wait for the price to dip as low as possible. For example, if you wait that the price goes here and too much, the RSI is in its oversold condition, or you just open the Binance and you just do the 4 EMA support. Let's wait until it's loading. Yeah. So you see that the price, for example, if the prices are right here, if the prices are right here, so you could see that that the that it has reached its support. And so what the swing trade means is that to buy at the market cycle and you wait that for that to end, and it could last for weeks, for example, or even months. So basically, depending on what your target is. So if you do the swing trade and you buy from here, for example, right here at 30,000, so you might wait, for example, you have decided to book a 20% profit. So as soon as the price reached here, and you see that sub it has the potential resistance as well at 34,000. If I can draw that for you, yeah, right here, you could see that from here the prices are usually going down from here, from here, from here. So if you have bought from this price of 30,000, so what you could do is, and you have the plan to go around 20%. You say that yes, I would like the ample profit for me to get out of this trade is 20,000, and you see that there is a 20 that there's a 20% profit here. So keeping in mind the dollar cost average, that you should buy in parts and sell in parts, what you can do is that uh, yeah, what you can do is that you could set your first order here, then you can set your first order here, then you can set your third order here. So what swing trader is, that it is not time bounded. It is just that you, based on the pure technical analysis and based on your profit calculation, you sell it. While, however, on the other hand, what intraday trading and scalping means is essentially that you aim to get some profit. For example, in terms of dollar, you aim to get $50 a day. For example, you aim to get a $50 per day. So that would be counted as intraday and trading and scalping trading. So as you can see that here, let me remove all the drawings, and that yeah. So if you see that if we aim for scalping, what we must do is we must look at the charts ranging from 1 minute to 45 minutes. Oh, 1 minute to 30 minutes maximum. And what this means is, like, for example, if we open 5 minute chart, and if you click here to reset chart, it would show up like this. Now, in a 5 minute chart, the volatility would be much, much higher than a 4 hour chart. So what you could do is that, yeah, so you would at least need two indicators to support your trade. And as you can see, it is a 5-minute chart. So the trade would happen. So the profit would be booked quite quickly. So if we could look here, for example, if we could say, yeah. So as I've discussed that exponential moving averages can before EMA setup could be used for swing trading. So what you could use here is the moving average. And at what value? I would recommend you to use that at 55 value. So let's set it up. And yeah, so if you could see here that 55, whenever the breakout is confirmed, meaning that, for example, if I could show you something, yep, like here, if I could show you here that how we can use the 55 MA is that basically we could use it as a support and resistance. What we could see here that these two candles have been that three candles have been successfully closed on the upward side of the 55 MA. So what we could expect is the prices to go up, up, up. So what you could do is you can take the trade from here and you could sell here. So for example, you could have booked around around 1.7% or around 2% in, let's say, around 20 minutes. So this is how you basically do the scalping. You book small profits and you exit quickly. So overall, if you could exit, for example, if you have 7 out of 10 successful trades, so it would mean that you would, depending on the funds, you might have get $10 to $20 easily per day. And if you have, the more larger the funds, the better will be your earning. For example, if you have $20,000 and if you get 10% on a daily, for example, you take 2%, 5 trades of and getting 2% profit. So it would mean that you would easily get around $200. So it depends totally upon your font size and everything. So basically, what I was trying to explain here was that if there's a successful breakout, then you could only take a trade. So these are around one, MACD, 55 moving average, RSI, and support and resistance. So these are the four indicators what you could use while taking a scalping trade. So if you could just see that how you could have done that here as well. So if you could see here that this line here, this line here is the support, as you can see here. So when the price, as you can see that it has acted as support perfectly here. So when the price just came nearby, I would have taken this trade here. And what basically would have supported me was, yeah. So what would have supported me was this crossover. So there's a crossover happening, and as you know that this is a smaller time frame, so there's quite high volatility, so you need to react quickly. So I would have taken trade from here and would have locked in here, because if you could see here that there's a potential resistance lying here. If you can see that this is basically the support for this region, this is the support, and basically you needed a very high volume to break this out and to hover, and then you needed a very high volume to break this down. So this line is acting as a support and resistance. When it was acting as a support, when it was above it, and when it is acting as a resistance, when the candles are below it. So if you would have taken the trade here and you know that this line is the support, so you could have closed here or a little below that, because you know that it might have touched it but not perfectly. So if you could have taken the trade from here, let's suppose, and if you could have closed here, so you could have easily got 1% profit. So these are the basic tips for swing trading. And if you just want to wait for a little while, for example, if you could have bought it here, if you could have bought it here and if you could have sold here, you could have also booked 2% profit. Basically, it is these techniques for scalping, and don't go on the percentages because it depends on what it depends literally on how much fund is your. So a 1% could be easily $100 if your fund size is quite high, and usually the scalpers have the quite high fund. And even if you don't have high funds, you could trade multiple times so that the overall percentage of profit could be 10% on the daily basis. So this is basically the scalping session where you could where I was trying to teach you that in scalping you have to take the trade and you have to exit it as soon as possible so that you could book the profit. So I hope you were able to understand the basic difference between scalping and swing trading. What I would recommend is that if you have, for example, $1,000, $1,000 is your budget, you could use some for the scalping and some for the swing trading. For example, if you could use 300 or 400, or even, for example, if you could use 400 for scalping, and if you could rest of the $600 for swing trading. So basically, in swing trading, you don't need to panic if the price falls below you because you should have funds and you should dollar cost your average, and so that your the total price of what you have bought is lower, and you kept making it lower. But once the funds are finished, you do not need to worry. You just have to wait patiently and you have to place the order so that you should have placed the order for selling it because as soon as it hits, for example, it could have hit during you were sleeping. The sell target could have triggered during you were sleeping. So you should have activated it before sleeping so that as soon as it hit that price, for example, if you were selling Bitcoin 35,000, so as soon as it hit 35,000, you should be right. The target would your trade would be easily completed and you should have easily booked the profit. And how to do that, I will teach you very soon. So I hope this would help you, and let's meet you next time. So hello everyone, I hope you all are doing well. In today's lecture, we will discuss, if I can show you right here, yeah. So in today's lecture, we will discuss about Elliott wave, Fibonacci retracement, and extension. So what this basically is the Elliott wave is the normal wave cycle of how the prices are moving up and down. While the before explaining the Fibonacci retracement, I would like you to know that whenever the price falls, for example, if the price was hovering above, there was a bullish cycle, and whenever this price falls, so this reduction is price. We can say that this is the depreciation, and as known previously, as I've already said in the previous lecture, that this is in the crypto market, this is basically known as correction. So here, in this, basically using this tool, we would calculate that how much would there be a reduction in price. So how do we? So this reduction is price. This is basically, as I have told you, that this is called correction, and other name for it is basically retracement. And so this Fibonacci retracement would let us know that how much the price would reduce. And before going any further, if you don't know about Fibonacci numbers, I would like you to pause this video and search first about the use of the Fibonacci numbers in the whole nature cycle. It has been used everywhere from our own body till everywhere in the nature. So first use first search about that, and so that you would know that how important this Fibonacci numbers are and how traders use this to get the buying and selling price. So let's start. So first we will draw this wave cycle. So where we can get the cycle is right here. And if you can see here, I've basically started and marked it. That's why I can see here, but you can do that here, there as well. So just wait a sec. Yeah. So basically we draw that, how we draw the Elliott wave cycle is like this. So there's one, there's two, there is three, there is four, and there is five. Let me And yeah, right here it is. So basically, there are two most important rules that before considering the Elliott wave. So the first and the basic and the most important rule, I would say, is that this fourth cycle, which you see right here, this fourth retracement cycle, and the ending point and the stopping point of this right here should always be above of that for one. For example, if you can see that this is right above one. So this is basically one of the most important rules. And if you can see on the YouTube, there are so many YouTubers explaining this, but they fail to recognize this, that this fourth should always be above the one. And now, the second most important rule, which I would like you to know, is that basically that I would explain using the Fibonacci retracement. So where you can get this retracement is right here in in this tool section. You can get this. So you can also start that at this Fibonacci retracement and this trend-based Fibonacci extension, which we will use later. So while using this Fibonacci retracement, oops, yeah. So while using this Fibonacci retracement, what we need to do is we need to calculate the retracement from how much that it would retrace, which I've already told you. If you don't remember, the retracement is basically how much the price will fall. So we need to calculate that from 1, how much the price will fall to 2, and from 3, how much the price will fall to 4, and from 5, how much the price will fall again. So in order to calculate that, we use Fibonacci retracement. So if how to use that is that you just have to select the price from 0, and then you have to take it all the way up to 1, and then you have to release it at this price. So if you can see that these are the numbers being shown here. And what I would like to, the second rule which I would like to highlight here is that as you can see that this as you can see that this how much this has retraced, it has almost retraced around 38.2. As you can see, the number is right here and it is in percentage, so it has retraced almost 38.2. So now if we draw this cycle from here to here, yep, so we can see that the one of the, well, this is the imaginary cycle, but I'll show you on the live chart as well. But as you can see that this, the second rule and the most important rule, and what it should follow, is that the retracement of the second from the first wave to the second wave, which is 0.382, if this is between 0. If this is between 0.23 and 0.382, then we would see much more retracement from 3 to 4. And as I have shown you, although this is an imaginary cycle, but for in order to get that 4 one, we have to uh, we have we have to keep. So let's remove this one first so that it would be clear. Yep. So in order to get that fourth one, we have to start from second and then end at third. And as you can see, the price went on to retrace around 0.50% or 50% to 61.8%. So this is the second rule. The first rule was that this fourth layer should always be above the first one, and the second rule is that if there is a little if there is a retracement which is between 20 to 30% in the second wave, so we would see much larger retracement in the fourth wave. So before moving any further, I would like you all to indicate that this 0.61a, which I have to circle here as well. Yeah. So basically this ratio of 0.618 is the golden ratio, is being considered as the golden ratio. And why is that so? In the trading perspective and in this crypto perspective, that if you see that the prices, when you will see on the live chart, obviously you will see that the prices are bouncing back from this 0.618 region, from zero point 0.5 to 0.786. and most of the time they will bounce exactly from 0.61a. So that's why it is being considered as it is being considered as a golden ratio. And what you have to keep in mind now while placing your buying orders, you have to keep in mind that you place your buy orders. For example, some right at zero point 0.5, and yeah, some you can set in between zero point 0.5, and then you can set, as you know, that it will bounce back from 0.618. Then you can set some targets here, and then you can set some of the targets as 0.786. Now if the price went below this target, for example, if the price retraces so much that goes below this target, then this whole phenomena will fail. But what you need to keep remember is that you have already by laddering this, like you have been buying in parts, and by this you have dollar cost average. You have done your dollar cost average, and what it means is that you have bought your coin at the average price. So you do not need to worry. You just have to keep hold on. So yeah, so basically, these ratios basically provide you with the exact numbers of how you can easily exact how you can easily place exact buy orders right here. So one more thing, what you need to remember while placing your orders is that the like while you are predicting the Elliott wave, you should remember that the prediction should be from the price should have completed its cycle from at least till 2. So basically you predict from 3 to 4 and 5. So that would be easier. And why I'm saying this is because you should have known by then that how much this second wave has retraced. For example, if this has retraced a little, then we would know that this would retrace more for sure. And if, for example, this has retraced till 0.618, then this might retrace a little less. So these are the things which we need to keep in mind while placing our buying order. So moving on to our analysis, let's move right here, and I've drawn this for you as well. That on the live chart, well, we have been doing the analysis on BTC, so I thought why not do it on any other coin as well. So this is basically ADA USDT or Cardano. We also call that Cardano because it is the company behind this coin, and it is also one of the top 10. It is also the top 10 coins. And so what we see here now, if we just remove the trend lines from here, yep. So what we can see right here, let's apply what we have learned. So what we can see is that we have to take this, let's draw it again. Yep. So what we need to remember is that we have to start the wave from the lowest point possible. So let's start it from here, and then we can see a price retracement. Then it went all the way up here. Then we can see a retracement here, and then went all the way up. So this is basically how you can draw on the live chart. Now we are here to validate how much what we have learned is possible. So first, if you take this Fibonacci retracement and if you draw it like this from 0 to 1, what you could see is that this second wave has retraced around 0.236 to around 0.3238. What it means is that basically it has retraced between 23.6 to 30, somewhat 30 percentages. So as the rule says that if there is a less retracement here, then we might see a possible much more higher retracement here. So we need to keep remember that this fourth should always be above the one. And let's draw the Fibonacci retracement from here, from second to third, to see how much the fourth has retraced. So now, as you can all see, this has perfectly followed what I have been telling you guys. If you can see right here, and if I can zoom right here as well. Yep. So what you can see right here, that this has perfectly bounced back from the zero point 0.6, near it, almost there, 0.618 region. And as I've already told you, that you have to place this the orders in this region and at this price as well. So as you can see that it has perfectly bounced back from this region. And secondly, it validates the rule that, sorry, wait a sec. Yep. Yep. So basically, it also validates the rule that if there is a less retracement, which we can see right here, that if there is a less retracement for 0.2, which is around, which is in between 23.6 to 38.2, then we would see a much higher retracement in the fourth wave. So this is how we could find the retracement of the second and the fourth wave. Now, again, moving back to our original diagram, how we can find, basically this completes the Elliott wave cycle. But the cycle doesn't stop here, as the price of the coins keeps on moving. So what this is, what we have to use here is basically this A, B, and C pattern. So what this is basically the correction wave. And as you can see, if I highlight you from right here, that this is the Elliott correction wave. So basically this tells us about how much the prices. Yep. So basically this whole phenomena tells us about how much the prices has fallen, how much the prices has started falling, because there needs to be a correction. And and as I think I've not told you guys about this, but the correction is good for the market. And why is that so? Because obviously you would say the prices are reducing, then how is it good for the market? Well, it is good for the market because of fresh money flows into the market. So basically it is good in that manner. So basically how you could predict that how much it would retrace from 5 is that, I'll remove this. And so basically you have, how we used to draw this is basically, yep. So basically, we draw the Fibonacci retracement from 0 to 1 to check out the second one, and then we draw the Fibonacci retracement from second to third to check out the fourth one, that how much this fourth one would retrace. Now, if we need to check how much the fifth one would retrace from here on, for example, let me show you. Yep. So if we need to see that how much from here the prices would retrace, what we need to, we, well, you would see on the YouTube again that they would do like this, that they would go from 0 to 5. Oh, so from 4 to 5. But that is the wrong phenomena. The right phenomena to check out the retracement for this is that you draw it from the 0. Oops, sorry, I've taken the wrong tool. The right way is to take the Fibonacci retracement and to draw it from 0 all the way up to the 5. And then you would have to see that how much this price would retrace. So this was all about Fibonacci retracement and Elliott wave. Now let's move on the Fibonacci extension. So now we have seen that how the Fibonacci retracement and Elliott wave works together. Now, another important thing which we need to see is the Fibonacci extension. And why is that so? Because it would help us to predict where this fifth one, where this final target would meet. And so, sorry, yeah, and where this fifth target would meet. And so, in order to do that, we would need to use Fibonacci trend-based extension. So you can get this from here, and it is below the Fibonacci retracement, and you can select it. So how to draw that correctly is this. It's like this, that you have to take it from 0 to 1. If you can see, there's a line going on. So you can take it from 0 to 1 if I want to show, because the price is right here. So I can take it right here, and the price of second one is going right there. So what this basically, let me zoom in a bit. Yep. So what this basically means, this whole tool is basically designed to see that if the prices of third one, which is this one, let me select the, yeah. So if the prices of this third extension, basically it tells us about how much the price would rise. So basically we could expect this third one to rise between 0.786 to all the way up to 1.618. But if we see that this third one is going between 1 and 0.786, it means that, um, yeah, so it means that if we can see that it is it is somewhere, the third one is somewhere between this region. So what we need to understand is that this is another rule, and I would like you all to write down all the rules which I have discussed in the previous lecture as well. And so what the rule says in the Fibonacci extension is that if this third wave is being retraced, for example, it has started to retrace from here. So if this third wave is retraced from 1 and in between 0.786, then we might see this fifth wave near that near that 1.618, this region. We might see it below, a little bit above it, a little bit below it, but it must be somewhere in this region. So this would help us. So basically, this would help us to set our buying targets. What we need to do is that you can set some of the sell targets. Just wait a sec. I'll take the trend line. Where's the trend? Horizontal here. Yep. So what we need to do is that we might set some target here, and then we might set some target here. And if we move a bit up, we might then set some targets here. So this basically helps us to understand how we can set our buying targets. For 3, we can set between 0.786 and 1. And if it has already been happened, then we can set, like if we know that if we are drawing till the third part, then we can say that our buying price could be around 4. And how we can do that is using this Fibonacci retracement. But once we have bought, then we could say that since it has gone on to up to 1, up to the perfect ratio of 1, then we might see this 5 somewhere near the 1.618. So let's see in our live example of ERA USDT. And so right here, if you could see that if we could draw the trend based Fibonacci extension, we would draw that from starting from 0, and we will take that all the way up to the part of 1, and then we will stop it all the way up to the part of 2. And I will just expand it a bit so you can see it clearly. Yeah. So as you can see, the prices, as you can see that although this hasn't followed this 0.7861, but it is somewhere near this region. As you can see that it was somewhere near this region. So that's why the price, the fifth price has hovered all the way up to above the above the 1.618. So basically this is also one of the most important tool to understand the selling target. For example, if you have bought from the fourth region, you can sell it, you can set your sell target for here, and then you can set your sell target to here, and then again you can set your sell target somewhere below it as well. And yep, so you can basically set your all sell targets so that you can get the perfect sale. And if you can see that if you would have bought from here, and according to that analysis, let me show you. Yep. So if you could have bought from here, and according to analysis, you should have sold at 1.618, then you should be in a 37% profit. And it would have happened from 13th May to all the way up to 16th May. Let me check that. Yep, from 13th May to all the way up to 15th May. So basically, in 2 days, you would have gotten 35% profit. So this is basically one of the important tool. And if you can see now the latest price movement, if you can see right here, so what we can deduce from here is that after this fifth wave, we can see that there has been, let me draw here. Yeah. So as you can see that after the fifth wave, there has been correction, and basically, which is the healthy correction. And as we have discussed, how we can draw this is basically using this Elliot correction wave by doing it right here or here. You can select it, and then right here, and then right here. So basically, this is the Elliott wave correction, which we can see right here happening. And then again, similarly, when there's a bull run again, and then again, this trend will follow suit. And so you can set targets accordingly. So I hope you were able to understand this lecture, and so that you would get great profit. So what we have discussed is basically using Elliott wave, Fibonacci retracement, and Fibonacci extension, and so you can get the perfect buy and sell orders. And if you are in loss, you would not panic sell at all, and you would hodl it, which means hold on to DL type, and which means not selling in panic. So I hope this was important for you and you were able to grasp all the knowledge from this lecture.